Well, it was another relatively risk-averse week for the financial markets last week. Equities softer across the board once more. Higher treasury yields pressuring risk appetite. Markets starting to buy into the higher-for-longer policy stance once more as economic data continues to prove resilient in the United States, and some worries about China in the mix as well as stimulus continues to disappoint over in Asia. All of that allowing the dollar to continue gaining ground up on the week against all of its G10 peers, apart from the pound, which remained relatively resilient. This week, it's all eyes on Jackson Hole, Wyoming for the annual Fed Symposium. Fed Chair Powell and ECB President Lagarde taking centre stage a little bit later on this week. It's another busy episode of the Trade Off UK, so without further ado, let's get into the show. So a busy show coming up once again this week. It's good to be back here in London after a couple of weeks away, although the illusion of this being a real studio and not a green screen has been somewhat busted by the last couple of weeks. A man who's been in the UK for that whole period is Ryan Littlestone from Forex Flow Live and Forex Analytics. Ryan, good afternoon. How are you doing? You're looking pleased as punch. I assume that's got something to do with the football at the weekend.
Yeah, football season's back on and we're off to a good start. So while that lasts, I'll have a smile on my face, probably disappear around about the end of September, maybe October, as I hope yours will as well.
Oh, well, I was going to say, we haven't even played Crystal Palace yet at the time of this recording. So God knows what my mood is going to be like on Tuesday. But I think over the early part of the week, at least, football's all that we've got to keep us interested. The data calendar is pretty quiet, isn't it?
Yeah, it is very this morning. And It perks up later in the week, as we'll speak about. But for now, yeah, we're coming in a nice, easy summer week, the calm before the storm, perhaps.
Yes, perhaps. I mean, certainly looking at the UK weather and the fact we've got a bank holiday weekend on the way, I think they probably put decent money on there being a storm or at least some rain at some point. But in any case, before this turns into a football and weather show, it's like a morning daytime television programme, let's get into Topical Thunder. So I want to start with Jackson Hole this week. The kind of semi-traditional sign, I guess, that the summer break is starting to come towards an end. The Jackson Hole Symposium over in Wyoming, the great and the good of the central banking world, gathering there for the annual symposium. Now, it's worth bearing in mind that we don't actually get the full agenda for the shindig until a little bit later on this week. I think usually Thursday afternoon is UK time, at least, is when the full schedule is published. But what we do already know is that both Fed Chair Powell and ECB President Lagarde will be speaking at the event. Now, it's an interesting one because there's kind of two ways you can look at this. Firstly, you can say, well, actually, Jackson Hole has been the venue for some quite significant policy announcements and hints in the past. You think when the Fed were looking at average inflation tightening, that was probably the most recent example of when Jackson Hole was really used as a signaling mechanism in terms of policy. Or you could look at it through the other lens, which is that it's just a sort of academic gathering where central bankers and PhD economists gather and go through all of the latest research, and given that it's a Friday afternoon, your time would be better spent down the pub. In any case, I think no matter where you are, it's definitely worth being aware of Chair Powell and President Lagarde's speeches at the symposium. They are likely to touch very, very heavily indeed on the near-term policy outlook. I think in terms of Powell, the risks for me, and I'm keen to get your views on this in a second, Ryan, tilt towards the more hawkish side. I mean, you look at some of the data we got last week, the US economy proving very, very resilient once more. Retail sales, industrial production, jobless claims, all coming in better than expectations. So while there'll probably be a fair chunk of flexibility and optionality in those remarks, I think it's pretty much locked in that Powell strikes a relatively hawkish tone and sticks to broadly the script from the last Fed presser, that higher for longer script that he's been using for some time. I think Lagarde is a little bit more interesting in my mind. It's the first time we'll have heard from the ECB president since the July press conference, and the first ECB speech that we've really heard since they kicked off their summer break 4 or 5 weeks ago. Given that it's going to be on a Friday night, I think the near-term immediate market impact may be a little bit more muted, but you've got to remember that markets see the September ECB decision as a coin flip, whether they hold or whether they hike. And if Lagarde once again nods towards the possibility of a pause or refuses to say that the ECB have more ground to cover, then there could be some downside risks involved there for the euro. So, Ryan, are you excited and teeming with excitement for Jackson Hole, or do you just think this is going to be a complete damp squib?
Oh, I can't wait, Michael. I absolutely can't wait. I'm not going to wait either. I'll give you a clue. But yes, it's this is always the inter-central bank meeting, summer meeting, or can be, if you like. It's important to know a couple of things. Firstly, we don't usually get big comments at the actual publicised events. But what happens is that the Bloombergs and the CNBCs and the CNNs all set up on the periphery outside in the grounds, if you like, all their little media huts, and they drag in anyone they can. And that's where you can sometimes get the choice comments. For this one, we've got to look at what is the market thinking going in, be that for the ECB, be that for the Fed. And if we take the Fed as a starting point, we're not really leaning hawkish or dovish either way as far as the market expectations go. They're pretty happy with what's going on with the Fed. It's going to be the data dependency that changes those in the main. So there's nothing really here, I don't think, for Powell to come out and say strongly to send the market away from whatever it's expecting at the moment. He'll be happy. He walked the middle ground at the FOMC. He's going to do exactly the same thing on this one. Maybe make a couple of comments on that inflation print that came in higher to say, obviously, the job's not done yet, but acknowledging that the economy is still doing okay. So those are probably the choice ones to watch for any comments on inflation and that higher print that we saw last week. For ECB and Lagarde, well, we know that once she's on a path of communication, that's what she sticks to. They kept usually. But we had touting rate hikes and keeping rate hikes in, and that's what happened, and staying hawkish. Then at the last ECB, move into a more neutral tone. So I expect that to continue too. And again, it's just a question of how, if we get any comments reacting to the latest data since all those central bank meetings. But unfortunately, unless we get something out of left field, and I'll be interested if Ueda turns up for this one. I don't think it's confirmed as to whether he's going or not, but that might be the key choice of central bank comments, because obviously their inflation is still ticking along and not pulling back as they expected. So yeah, I'm not expecting any fireworks from this one, but it is some weekend risk to be aware of when we come back in the next week.
Yeah, definitely. It will be interesting if any of the other major central banks send anyone over. As you said, Ueda, Bank of England Deputy Governor Ben Broadbent is going. He's actually, this poses you a bit of a conundrum, Ryan. He's speaking at 5:30 on Saturday afternoon as you kick off against Brighton. What on earth are you going to do? You have to get 2 screens set up in order to watch them both.
Well, I might ask Brighton Football Club if they can put it on the big screen instead of the replay of the matches, and I'll watch the game and watch him on the big screen as well. I'm sure 25,000, 28,000 fans there will be very happy with that.
I'm sure they would indeed. But yeah, we will obviously watch the full agenda of that in detail. As you said, it is a little bit of weekend risk to throw into the mix as well. And somewhere else there's plenty of risk coming out from is China at the moment, isn't it?
Yeah, front and centre of the headlines, if you like, and the market really growing a bit more pessimistic on Chinese growth. Things like that have hotted up after the run of bad data that we've seen, further bad data. Since we did the last show last week, we've had industrial production and retail sales on the soft side of expectations. Officials have been forced to step in further to intervene in markets. State banks have been told to escalate yuan interventions, and we're seeing selling dollars in both the European sessions and US sessions. They've now asked private funds to quote, consolidate confidence in stocks, and asked other funds to avoid net equity sales altogether. Other firms in the tech sector, they've urged to, start buybacks from some of the big firms in tech stocks. They've been cutting rates across the board that we've been speaking about, including their loan prime rate today, although they only cut the 1 year by 10 pips, which was 5 pips less than the market was expecting, and they left the 5 year unchanged, which again surprised people. And that's on top of a lot of localized easing measures, if you like, for mortgages, property purchases, new electric cars, and so on and so forth. Then we've had the big Chinese funds having to restructure payments. We've had Evergrande hitting the headlines again, filing for Chapter 15 bankruptcy in the US. So every which way you turn, the news has been negative from China, and the market is now slashing their forecast for growth. Some coming down below even China's expectations of 5%. But this still all comes while the officials themselves are seemingly dithering about, how they react to this. They're not really grabbing the situation by the scruff of the neck, and this could intensify stock market sell-offs and the yuan sell-offs unless they do step in hard to try and fix things. But again, another problem is that China has ruled out going down the flood-like stimulus route. So I think we're in a situation where the market's going to push them to do just that, and they're not quite ready to do that. And on top of it all, even officials last week coming out and saying that the FX moves are in line with fundamentals, or they're not any way excessive yet. But then they warn we don't expect the one to weaken any further or more further in the second half of the year. So they're talking of one game, they're playing another game, and the market's in the middle trying to guess what the hell's going on. And it doesn't bode well at the moment.
No, it doesn't, and I certainly haven't got a clue what the hell's going on. To be quite honest, I'm not sure anyone in the Western world does. In fact, I'm not sure that many people in China do. It's an interesting one. I mean, the whole stimulus thing it's almost become a little bit of a joke at this point. It's just a sort of easy narrative on which to pin any sort of risk aversion. Oh, the market's disappointed in terms of Chinese stimulus, and in fact, I was guilty of that right in the show introduction. I mean, the crux of the matter is they're basically pushing on a string at this point. No matter how much more stimulus they deliver, the actual impact that will have on the economy is questionable at this point. I mean, you're looking at now real kind of structural issues. I mean, we've spoken at some length on this show about youth unemployment in China and how that's at record highs. Well, China have come up with a very Chinese solution to that problem. They're not going to publish youth unemployment data anymore, which kind of speaks to how bad the situation really is. And it also makes me chuckle that, everyone's revising down their Chinese GDP forecasts. Well, why bother making a forecast? Because they just make the thing up anyway. I think this is the lens you've got to view it through. The data that we're getting is pretty poor, but it's made up to look better than it actually is. So how bad are things really on the ground? As you say, the whole FX side of the story is a little bit peculiar. You seem to have the right hand of rhetoric not really talking to the left hand of actual monetary matters. That doesn't seem particularly right, and I do wonder how that resolves itself. But the bigger thing that I've been sort of mulling over a little bit over the weekend is I'm just starting to wonder, you've said rightly there, the market's pessimistic on Chinese growth. At what point do we get to what you'd call peak pessimism? You look at Chinese news at the moment and there's basically nothing good in it. Everything is a negative story or a bearish narrative or headline or whatever it is. At what point do you reckon we can turn around and say, actually, this is probably the peak? I mean, maybe we're waiting for the Economist to put this on their front cover and then we can all go and buy China or something.
Yeah, I think you're right. And that's what I think that the trade's going to be, because the market is going to want China to react. They're not going to suddenly come out with QE or any big policy measures like that, because that's just not them. It would be a shock if they did. I think at the very most what we might get, however you want to call it, fiscal spending, helicopter money, where they inject actual money into the economy. They hand out money to people basically to kickstart consumption. But I don't think they're going there yet. So what I think we've got is all these smaller measures, rule changes for mortgages and property purchases and tax cuts for new electric vehicles and trying to get consumption boiling again. I think they have to give them time for those measures to come into effect and to have an effect. But we know the market's got a short attention span. If it doesn't see fast results, it's going to push. It's going to sell the yuan. It's going to sell Chinese stocks. And if that gets too much, if we start seeing some big moves in the yuan and big moves lower in Chinese stocks, that'll get us to peak pessimism. That's when China will sit up and go, well, you want to fight us on this? Well, now we're going to hit you hard. So that's what you want to look for. It's really the market reaction. If we get dollar China running up through 740, 750, that's getting to peak pessimism. If we get Chinese stocks collapsing, again, peak pessimism. So it's the market that's going to tell us that, I think.
Yeah, I would agree. I think actually, perhaps counterintuitively, if China were to do a kind of bazooka-like stimulus, for want of a better word, that might actually be more cause for concern, because then you're going to be in a situation where the market is kind of asking itself, well, hang on a minute, what do the Chinese authorities know that we don't? What are they so worried about that they need to deliver something massive and go completely away from the sort of blueprint that they've previously laid out in terms of trying to engineer an economic recovery? You then start asking yourself, how bad are things really in China? And that could actually do more harm than good, at least in a financial point of view.
Yeah, very much so. But on the flip side, if you suddenly do get some really strong action, stronger than we've seen before, it's probably going to lift risk, because the market's then going to say, well, they're finally taking note and they're finally doing something about it. We'll see Aussie, Kiwi commodities all running higher on that basis, and a good bout of risk on.
Yeah, absolutely. And of course, that liquidity would have to go somewhere, and you'd probably put money on it going into the stock market. In any case, we could probably talk about China all day, but we're not going to. We're going to move on to the UK, obviously back in the UK this week after a couple of weeks away. And it seems like I might have brought the sun back from New England with me, judging by the weather in the city today. As you noticed last week, Ryan, it was a big week for UK data last week. We had the latest jobs, inflation and retail sales figures. So let's just take them in turn, really. The jobs data was, now there's two ways you can look at it. On the one hand, you could say, well, it's actually pretty strong. We had 8.2% year-on-year earnings growth. All is fine and dandy. But actually, when you dig into the report, it was pretty grim. Unemployment rose to 4.2% in the 3 months to June. Obviously, the data is a couple of months in arrears. June also saw the biggest 1 month fall in employment since records began all the way back in 1992. And actually, even that earnings print was actually very distorted by a number of one-off factors. June was the month when the NHS got their pay settlement. There were some one-off bonuses paid in there as well. So that just skewed the number quite sharply higher. So I don't think we can read too much into that. And that just kind of papers over the cracks a little bit in terms of the labour market. On the inflation side of things, I guess some glimmers of hope are starting to emerge if you put your blinkers on and only look at the headline inflation print, which came down to 6.8% on a yearly basis in July. As we've spoken about at some length in the past, that was all driven by energy. The way the UK calculates its energy prices, they're capped. That cap, or that price guarantee from the government, gets revised every 3 months. July was a month where it was revised lower by £1,000 or so. So, of course, there's a big drag on inflation coming from the energy component. If you look at the metrics, you take out energy, core remained unchanged at 6.9%. If you look at what the Bank of England are worried about, which is services inflation, that is remaining very, very sticky indeed, actually re-accelerating to 7.4% in July. So that will be a little bit of a concern. And then you look at retail sales, and retail sales really gives you the story of the cost of living crisis, because the ONS produce a volume and a value metric. Sales value continues to increase. Sales volume continues to decline on a year-on-year basis. You are spending more to get less. That is how inflation works. On the month in July, retail sales were pretty soggy, quite literally, because the bad weather was what was to blame for sales falling 1.2% on the month. And given how August started, I don't think things are going to be much better this month either. What does that mean, though, in terms of sterling? Well, sterling didn't really do anything last week, but that in itself was quite an achievement, given that the dollar was marauding higher across the G10 board. So for the quid to just remain in the mid-127s when you look at cable was pretty good, all told. What does it mean for the Bank of England? Well, I think if you look at the fact that we're now getting positive real earnings growth, about 1/3 of 1% on the year in June, and that should continue into July, You've also got sticky services inflation and sticky core inflation. I think we're going to get another 25 bips from the BOE in September, but the market's still pricing another 2 hikes after that. I looked this morning, terminal seen at 5.9%, and I'm going to say it now, and I don't want this to age as badly as the last call, but 6% does feel quite punchy.
Oh, well, you're only punching a whole 100 pips above where you were last punchy, so yeah, you might get it right one day. But no, I actually agree with you with this one. I agree with you with this one. As I've been saying, I think 5.5 at the very most, 5.75 is going to be the top for them. Wasn't a surprise to see a big drop in the headline inflation number. We were saying that before the June reading even. This month is going to be the time where we did see a big fall off. And those wage numbers, as you say, the public sector wages are not going to stay in there forever, and doesn't mean they're going to drop, but the rises are going to come out of the picture. So perhaps next month we see a bit of adjustment to the wage numbers there. Private sector was still pretty strong though, so that's what you need to keep an eye on as well, because that makes up the bulk of the inflationary pressure, if you like, from wages. But some things going the right way. I do think it keeps a hike on the table for September. I think after that, it's a different game altogether. Retail sales, I agree with you again. It was soggy, much like the weather. As you say, August has been bad. I won't be surprised if we saw another soft print from the retail sales next month, middle of summer. But not that you'd know it. It's supposed to be a fairly big retail month because a lot of people have been staying in the country this year. So, you know, the pressure is on, and this is what you've got to look at. If we get another soft print in retail sales, and then one after that, once everyone goes back, once the kids are back at school and everyone's settled down, then the pressure is going to start mounting on the Bank of England, I think. And we've also got to watch for that inflation pressure. We've seen it in the US where, you know, inflation jumped. I looked at Canadian PPI data last week as well, and that was all higher when it's expected to come in lower. So just looking around different countries, there has been a little bit of a pickup in inflation. If it's going to hit anywhere, it's going to hit here in the UK probably twice as hard as everywhere else. So lots of them to consider, and we'll see what. Would you say Broadbent was is going to be at Jackson's Hole?
He is, yes. Saturday afternoon, Ben Broadbent is over there.
Yeah, we may hear something from him, give us an indication what they might be doing in September.
Yeah, definitely. I think the economic data over the autumn here in the UK is going to be really, really interesting because, you know, we've all done it. You know, retail sales, it rained a lot, it's soft. You can do that for a month. You can probably get away with it for 2 months. But, you know, 3 or 4 of those and it starts to become a trend. And no matter how wet it is, you can't really blame the weather anymore. And, you know, you think about the other things that are going into the mix come the autumn. We would expect inflation to continue rolling over at the headline level, at least, because of that energy impulse. But really, we need to look at what happens to core, what happens to services. You look at the labour market, we're seeing some pretty significant signs of softening there. And you would expect that to continue throughout, well, the summer, because the data's for June, and into the autumn as well. On the consumer side, obviously, you've got the mortgage refinancing issue still to come in. I mean, what is there? You know, a couple of million fixed rate mortgages under 2% that still have to roll on to 5 or 6% deals. And again, that is going to have, you would expect, quite a negative impact as we roll into the third and fourth quarters. So, yeah, the Bank of England have got a very, very difficult job coming up. I don't feel any sympathy for them whatsoever. Let me make that quite clear. But they do have a difficult couple of months because you've got sticky inflation and what's looking like pretty anemic economic growth. And yeah, good luck getting out of that.
Yeah, very much. And that's one thing you have to look at as well. You know, these retail sales are going to impact GDP as well because, you know, just one small anecdote. If you've got a lot of people who are heading to the coastal towns around the UK and it's bad weather, they're going to sit in their hotels. You know, all the trade that would happen on those beach fronts is not going to happen or hasn't happened. And that's all going to work its way down the chain. So I wouldn't be surprised if the next quarterly reading for GDP was coming in a bit soft as well.
Yes, indeed. Well, plenty more days coming out this week as well, isn't there? My favourite week of the month
You love the PMIs, I know you do.
I've got a T-shirt with PMI.
I bet it doesn't stand for Purchase Managers Index, though. Anyway,
comment below what that might stand for.
I'll let the viewers work out what that stands for. Right, so it's PMI week this week, and we get all the flash readings from a lot of countries, starting off in Australia, Japan, Asia. On Wednesday, we're getting both the manufacturing and service sectors, so a good early reading. Now, manufacturing really has gone down the plug hole globally, and services the last couple of months have been sort of circling the drain. So are we going to see further weakness or a bit of a bounce? The early US manufacturing numbers via the Empire and the Philly Fed, they're just regional surveys, but they're the first ones of the new month, so a bit of a bellwether. Well, a bit of a bellwether usually, not this time. The Empire headline was much worse than expected and turned into a big negative from a positive number. The Philly Fed was much better than expected and turned a negative into a positive number. But what was key for me is the underlying components of both those pieces of data were more aligned. They both showed employment lower and they both showed input prices going higher. That's going to be the key thing for the Fed. It's not the right cocktail for them if they want to see soft landing numbers because they can now get lower employment and potentially higher inflation. So the way to look at this week from a global perspective and country specific is maybe the expectations are pretty run of the mill. There's nothing really extravagant expected from these numbers. So there's little change expected from both the manufacturing and service sectors in the interim expectations. And I personally don't see any reason why these numbers should improve to any greater degree. And if we see further softness, that's going to play into, recession fears. But for trading it, look at the numbers in their real basic terms: activity, inflation, and employment. For example, if all three are weak, that's not going to look good for risk trades. If activity rises but prices are lower and employment holds up, that's going to tick the soft landing boxes. Now, there's obviously plenty of permutations you could look at for this one, but what it could do is shift central bank expectations quite a bit, and thus markets, particularly ahead of all the appearances of Jackson Hole.
Yeah, indeed. I think the US data is going to be particularly interesting, actually. I mean, as we alluded to, I don't place that much weight on the PMIs, but just when you think about the way the market seems to be thinking about things at the moment is very much this idea of US exceptionalism. The US is doing fine and the economy is performing well and it's all resilient, and actually elsewhere things are looking pretty grim. UK, Europe, China, wherever. If you start to see those PMIs out of the US begin to turn, that could be a little bit of a spanner in the works of that narrative. And maybe then the moves that we've seen over the last 4 or 5 weeks, the dollar grinding higher, treasuries being sold pretty relentlessly, particularly at the long end of the curve, maybe that then gives a bit of an excuse for some traders to take profit there, or even to start think about those various assets going the other way. So yeah, definitely all eyes on Jackson Hole this week, but the data shouldn't be ignored.
No, very much so. And it's probably going to be the biggest data point of the week this week. We do have, I think, Michigan flash sentiment on Friday to finish things off, but it's going to be the PMIs that are going to rock our worlds, hopefully.
Absolutely. Rock our world. Oh, so exciting.
Oh, look at you, said with such excitement. Oh, I'd love to take you to a gig one day. I'll take you to one of my heavy metal gigs and we'll see if you can stand up to the rocking.
As long as I can bring a chair, I'll be all right. Right, let's get on to some charts in That's a Setup. Now, the world's longest title sequence is over, so we'll get into the charts. I want to start with gold this week. As I've come back off annual leave, looked at a million charts over the weekend and this morning to try and bring myself up to speed with what's going on. And one that I like to look at quite often is, and I haven't shown it here just to show you the technical setup, but is gold plotted against its various drivers. You look at nominal yields, real yields, the dollar, risk appetite. You can use the S&P as a proxy for that. And you look at a chart like that, and I'm sure you can build it on Bloomberg or TradingView or whatever platform you're using, and it just doesn't feel like the yellow metal's got really much going for it at the moment. The dollar, as we know, is continuing to maraud higher pretty much across the board, and obviously gold is primarily priced in dollars, so that's going to be a headwind. Yields are rising, nominal yields, real yields, both rising across the curve, particularly at the long end. So you've got to consider gold is an asset that yields nothing. Bonds are now yielding more and more and more, so they become increasingly attractive. And despite equities moving lower, gold hasn't really found much haven demand either. And I think that move higher that we see in yields is a contributory factor to that, because everyone's now looking and going, well, if I want a haven, I'm just going to buy treasuries because I can get 4.5%, 5% in terms of my yield, rather than putting it in to gold, which doesn't return me anything. So actually, gold, as I said, doesn't really have too much going for it at the moment. On a technical basis, things are looking pretty weak as well. We broke below $1,900 an ounce last week. We also now trade below the 200-day moving average for the first time since December of 2022, last year. Excuse me. So it does look like the bears are working pretty hard to drive price lower. We are in this descending wedge or triangle, whatever you want to call it. I think we could see 1850 in relatively short order here if we continue to see the market trading as it is, and if we do get that hawkish message from Powell on Friday. And for the bulls, if they want any relief, they really need to get back above that 200-day moving average, which comes in at 1905. So not one I look at too often, but just thought it interesting to share gold to kick this week off.
Yeah, it is a very interesting chart, this one. I mean, I know you haven't got it on your chart, but you can just see at the bottom of the screen on the left-hand side, the November, October 2022, we've got an actual low there, and if you can mark a fib all up to the prior highs, that comes in at around 1895, which was that low you can see round about in was that middle of June on there, that low down, that first touchdown towards that level 1895 odd. We've actually broken below that fib, so that's really important. We've broken below that 38.2 fib, and what we're doing, as you can see from your line there, we're holding the break at the moment. So we're holding that 1900 break, 1895 break. If we continue to do that, that's going to be a kicker for a move down to 1850. So if you're looking at this one and you want to play from the short side and looking for where to get in, as long as we hold below that 1900 level, that's your leaning point if you want to get into shorts and maybe get a push down. Get back above there, though, you need to be very careful, because it could mean we've just had a little bit of a fake out and we're heading back up again.
Indeed. Well, next week I'm going to bring a little whiteboard marker so you can draw on the chart the things that I've missed.
I might as well do it all for you in the first place.
Well, I mean, given how many notes you've written on the next slide, I think you pretty much have done the whole show for me.
Here he goes again, moaning about my in-depth knowledge that I wish to share with the viewers. I don't know. Well, let's get into it.
GPT is quite good these days, so they say.
No, it's type 2 fingers PT for me, I'm afraid. But going to look at dollar China, and really just to continue the theme. I know we like to switch up between different assets, but while we've got a running theme, particularly with China news hotting up, it's worth keeping an eye on this one. So last week I was musing we may be back in the hunt for a move to the highs at 737. We had a bit of a month-long pullback from the 728 level. That's where we got up to 735 after breaking back up through 728. Then we've had the ramping up of intervention, and there's been a bit of a roadblock put in around this 735 at the moment. And as mentioned in my analysis earlier, the market might be thinking that China won't bring out any big monetary or fiscal bazookas, and thus will continue to sell Chinese assets, including the currency. So we may still see further gains for dollar China, dollar yuan. However, I've been trading this one for a long time, and it's very important to follow what officials say and do regarding intervention and what they say about market moves. And in this, they're saying one thing as mentioned, but doing another. They say the currency moves are okay and normal now, yet they're intervening the most they have in years. However, they have also said they expect yuan weakness to ease in the second half of the year, which is, again, a clear signal of intent. So the longer officials keep intervening but not seeing those significant results for that intervention, the greater the risk grows that they're going to stamp on it much harder. So with that in mind, and given the level of intervention already, I'm looking and already playing this from the short side. I'm currently short very, very small from 731. And I'm looking to play this back up to those 735 highs, maybe even the prior highs up at 737. I'm not going to be slow to take any decent profit if I get any seen on any of my entries in this one. So pull back 200-300 pips, I'm going to knock some of the trade out. But if we get a proper break of 737, that's going to likely invalidate this strategy. Main support right now is down into that 728, quite clearly on the chart there, level of the old high. We held it on the pullback from this recent high, clear as you like in terms of the technicals. After that, it's 721. If we get back down there, it might change the picture a little bit, but your bigger level, really big level underneath it is around the 710, 712, so quite far away from that. But for now, I think the officials are putting the brakes on a little bit harder up here, so I'm happy to play it from the short side.
Yeah, I think that's an interesting one. And as your chart very clearly shows, it's been kind of one-way traffic up and to the right for the vast majority of the year. And, we've spoken at quite some length that it is going to get to a point where officials do start to worry and try and stamp down on that. And, given that we've come a long way, and particularly if you've been riding that wave for most or even some of that period of time, it is probably prudent to start thinking about locking in some gains and just becoming a little bit more cautious and tentative at these levels, given that the potential for a big intervention to stamp on things and knock things back down is getting that much higher.
Yeah, very much so. I mean, those who've been watching the show for a while know that I've been playing this from the long side when we were right down in the sevens and through the mid part of the sevens. So yeah, there's always times when you want to go with the trend and there's times when you want to go against it, but you need some strong clues to go against this trend.
You do indeed. Right, moving on. I want to talk about the S&P this week. Ryan was allowed to mention it last week, and you've also mentioned dollar China for about 8 shows running now. So I'm not hearing any complaints whatsoever about my mentioning of it this week, particularly as we are actually getting quite interesting here. Almost the moment we stopped recording the show last week, actually, the S&P 500, this is the front month future, by the way, broke and closed below the 50-day moving average. And that's the first time we've done so and closed below that level since March, all the way back in Q1. So that really brought a new round of sellers in, really emboldened the bears and got us back below the 4,400 mark into the end of the week. And we remain, below that mark this morning, or this afternoon, I should say, even though risk appetite does seem just a little bit steadier to start the week. As we touched on earlier, plenty of factors behind it. Tech coming under pressure as yields rise at the long end of the curve. You've got worries going on about China, stronger data, higher for longer. There's plenty out there that's feeding the bears at the moment. And I think the real level that I'm going to be watching like an absolute hawk at the moment is 43.25. Why that level? Well, that was the high that we saw last August. On the way up, we sliced through it very, very quickly indeed. So we may slice through it quickly again to the downside. But more importantly than that, it's also roughly where the 100-day moving average comes in. And that 100-day moving average, again, is a level we haven't traded below since March time, sort of mid-March. I think if we do manage to get a closing break below those levels, then we're probably going to see 4,200 in relatively short order. Personally, I'm in wait and see mode here, as most will know by this point. I tend to be bullish equities. That is my innate bias to do so. But I do think we need to wait and see how price reacts at that 43.25 level, see what Powell has to say on Friday. But if we can hold there, then dare I say it, that might be the time to come in and buy the dip. If not, then it's one to be riding to the downside.
Yeah, that 43, you've got 25, I've got it around about 43.30, all the way down to the big figure. A lot of tech confluence in there. We've got fibs in there. You've got the moving average in there. It was a strong point, as you say, on the break higher. So an really old traffic zone there. So probably the biggest test of the rally so far that we've seen this year. And for the upside, we've seen it this morning we're seeing a little bit of risk on. It doesn't look anything significant, but it's pushed S&P up towards that 44 handle. We've got some intermediate levels. I had 43.80 as an intermediate level, which we broke below last week. Then put in a small short-term intraday low around 43.60. Then, as you say, we broke that down to the lows last week. This morning, we got back above it. We're holding 43.60. We broke back above 43.80, held that as support now as well. So really, for me, to see further upside, we need to get back above 44.0010. The big level for me, though, above is around about 44.5, 45, up to 44.60. If we break that level, that's really going to turn around this dip that we've seen from those 46 highs. But until we do see that, then I'll remain short on this one and bearish.
Yeah, as you say, it is getting towards a very, very big test indeed for the rally. One thing I do want to say about this, just before we move on, and it's winding me up, as most things tend to do these days. There's a load of folk on Twitter, and actually sell-side strategists are starting to do this as well. Mike Wilson at Morgan Stanley. They've been short since last October. They've missed a 20-25% rally. You see spoofs come off 5% from the top, and all of a sudden they're taking a victory lap. That's not really how this works, guys. Come on, grow up. Right. What about gilts before I get myself in trouble?
Yeah, well, before we could both get ourselves in trouble talking about bank calls all day, we should do a show on it. I won't even mention Citi and their short oil recommendation last week, which managed to mark a bottom in oil as well. But we shall move on from that one as well. I'm going to look at 2-year gilts and really a Bank of England trade. And as Michael suggested, trading the peak rate here. Expectations still topping up around close to that 6% mark. So short in yield, going on price, up into 550 towards 6% could be a good trade here, especially if the higher rates are already going to bite harder into economic activity than elsewhere. The UK could become one of the more anticipated rate cutters of the majors, and that will mean some heavy dovish expectations, meaning there'll be potentially more bang for your quid in this market than perhaps US or Europe. Now, looking at the levels, as I say, getting up to 5.5, 580 on the chart there, you can see these are multi-year highs we're at the moment. And that's your marker, really, for this trade. If you want to get long, definitely anywhere close to 6%, it could be an absolute dream. Obviously, if we bust above that, then your trade's invalidated once again. But you've got to watch out for the odd spikes. So you might need to give this one a lower amount of risk, but a wider stop if you're going to be trading that. If we do see the UK economy faltering more than the others and those dovish expectations ramping up, you're probably going to see this down at 4% pretty quickly. Michael's going to love this one because it's bearish both the UK and negative the Bank of England. And he gave a spoiler out on Twitter earlier. Terrible stuff, mate. You can't be giving spoilers out on Twitter for this one. But he should love this one anyway.
I was going to say, looking at the number of views that tweet had, I think you might have been the only person who was spoiled by it, and you wrote it. So, and also, we can't call it Twitter now; it's X.
Oh, X. Sorry, X.
Yeah.
If there's anyone on it anymore, I don't know. People dropping like flies, I think.
Oh, exactly that. I haven't really got anything to add here, to be honest with you. As you said, bearish UK, bearish BOE, right up my alley. This one.
Good. We'll move on then.
We shall. Let's get into this week's trade ideas. I want to look at the dollar this week. As we've mentioned earlier on in the show, the dollar continuing to gain ground last week against all of its G10 peers, apart from the pound where cable traded pretty much unchanged. And that's taken the dollar index to 2 and a bit month highs, the highest we've seen since the second week of June, and north of the 103 handle as well. More importantly than that, we've actually managed to close above the 200-day moving average for the first time since last November. And even more importantly than that, we've actually managed to hold above the 200-day moving average on a couple of tests since that closing break as well. So things starting to look rather constructive here. The dollar has a lot working in its favour. Obviously, the rise in yields is continuing to help, and the risks being tilted towards a more hawkish speech from Fed Chair Powell on Friday, particularly relative to market expectations, are helping things along as well. So I'd be looking to be long the dollar this week, looking for 104 to take a little bit off, then 104.5, which was the high that we saw in May and June, where you'd be looking to perhaps close that position out. To the downside, that 200-day moving average is the key support, and then you've got a trend line below at 102.75. But until we get to Powell, and probably after Powell as well, I'm happy to be buying the dollar and hopefully wearing diamonds as well. Ryan, what are you looking at this week?
Well, another war and peace trade from you there, Michael, has been duly noted. I'm going to keep mine very, very simple. This is the Kiwi versus US dollar. Very easy. Buy on the dip, buy on the fib, and flip on a potential break. A simple technical play. We've got a big level down here at 59.00. It's a psychological big figure. It's also the 61.8 fib of the October to October 22, February 2023 low high. So very much a big line in the sand for that rally. I'm going long. I'm already long, right into the level at 59. Even though we've tested the lows a few times and the bounces have been pretty weak, it's still a big enough level that I want to give it a go. But in case of a break, I'm going to flip it short below that trend line, which sits around 58.90, just below.
Good stuff. Long the Kiwi dollar. So by proxy, you're long sheep as well then in that case.
I don't know how to answer that.
Right, on that note, that brings us to the end of another show. Thank you very much, as always, to Ryan Littlestone from Forex Flow Live and Forex Analytics for joining us. Thank you also to our producer, Kyriakos, for bringing this together as brilliantly as he always does. If you've enjoyed the show, drop a like on the video, leave a comment as well. Let us know how you've been trading the markets or if there's anything that you want us to cover in next week's show. And we will see you again in a week's time. Thanks as always for watching, and goodbye for now.